Okay. Now let's try to see the inventory turnover days, how to calculate that. So basically inventory turnover days simply tells you that how many days you are going to take for the inventory to get its turnover done. So inventory turnover ratio is simply you can either use the inverse of your previous formula. So the formula for inventory turnover ratio was the cost of goods sold divided by average inventory. And if you want to calculate the inventory turnover days, so average inventory is above and cost of goods sold is below, and then cost of goods sold is being divided by 365, so that you calculate your per day effect of inventory. Now let's go and see our average inventory and our cost of goods sold. So if we go to our P&L and balance sheet here again, so this is our profit and loss statement, and within that the cost of goods sold is given as $250 here, and the numbers are in thousand, but I am saying $250. And your inventory is for the current year, which is your closing inventory, and $70 which is your opening inventory. So your average inventory will become $75. So if we go further and see here, where was the inventory turnover ratio? Yeah, so if we go here within the inventory turnover days, we can say inventory average inventory is 80 plus 70 divided by 2, which shows us 75, and cost of goods sold is 250, and that needs to be divided by 365, so that gives us 0.7. And if we solve these numbers, so we get 109 days. It simply means that on an average we hold inventory for 109 days. So holding the inventory for 109 days is not a good thing for the company, because larger the period you are holding the inventory, lower you will be able to turn it around. So this shows the inventory turnover days of 109 days. Now if we go ahead, then why the companies use that? Because it shows how long money is locked in the inventory before it turns into sales. So basically the inventory is sitting within your P&L or your business for 109 days. So definitely your money is locked into the inventory for 109 days. And the shorter are the days, faster is the cash cycle. Instead of 109 days, if the inventory days were 10 days, which means that inventory in your warehouse is sitting for 10 days, then if the days were shorter, the fast money you will receive, because immediately after 10 days it would have been sold. The operational efficiencies are also there, because it helps to identify if inventory is moving slowly. Because if there are number of days higher, it means inventory is moving slowly, and when the inventory is moving slowly, there is a chance that the expiry will be there, or obsolescence will be there, or the other problems might occur. Similarly, you can go and plan for benchmarking. Companies can compare their inventory days against the industry, how much other people are having inventory turnover days. Example, if we take grocery retailers aims to have for very low inventory days. Why? Because grocery will get perishable, they will get disturbed if they are not used quickly. So grocery business is having very low inventory days. Luxury goods brands may have higher inventory days. Why? Because these products take longer time to sell. And lastly, the investors and credit analysts also uses this kind of analysis. Now if we see the real world example, so Amazon works on a very low inventory days. Why they works on very low inventory days? Because it wants very fast moving goods products. All the goods which they are having, they are sold on very quickly basis on Amazon. So that supports the fast cash conversion cycle, because the faster inventory is getting sold, faster it will be turned into cash. If we see the example of Tesla, in earlier years Tesla had very high inventory days. When it started, there were very high inventory days. Why? Because the cars were built to order and sales were taking too much time. Over the time, they have reduced the inventory days and improved the cash flow for their business. And lastly, if we see the fashion retail company just like Zara, so Zara is a famous for very low inventory days. Why they are having low inventory days? Because they produce their products in very small batches. They don't produce excessively stock, but very small batches. They sells it fast and replenish often. So this avoids the old stock becoming unsellable. They don't have much of old stock due to changing of trends.